Imagine you want a piece of a giant pizza, but you can't eat it all. You buy a slice. That slice represents ownership in the whole pizza. Stocks are similar. A stock is a tiny piece of a company. These pieces are called shares. When you buy stock, you buy a share in that company. You become a shareholder, a part owner. You're not buying the whole company, just a small part of it. Just like owning a slice doesn't give you the whole pizza. Your stock doesn't give you control of the company, but just like the pizza owner, you get a share of the profits. Companies share profits with shareholders through dividends. The more shares you own, the larger your slice of the pie, and hopefully that pie keeps growing. Why do people buy stocks? They hope the company will do well. If a company grows and makes more money, its stock becomes more valuable. Think of it like this: the tastier the pizza, the more people will pay for a slice. When a stock becomes more valuable, its price goes up. If you sell your shares at a higher price than you bought them, you make a profit. This is called capital appreciation. It's like selling your pizza slice for more than you paid for it. Of course, stock prices can go down too. If a company isn't doing well, its stock price might drop. This is why investing in stocks always carries risk. Your slice of the pizza might get smaller or even disappear. Many things can affect stock prices. Company performance is a big one. If a company releases a great new product or service, its stock might go up. But bad news, like disappointing sales or legal troubles, can make the stock price fall. The overall market also plays a role. When the economy is strong, stock prices tend to rise. When the economy weakens, prices often fall. Think of it like the mood in the pizza place. A happy crowd usually means more pizza sales. Investor sentiment, or how optimistic people feel about the market, also matters. If investors are confident, they're more likely to buy stocks, pushing prices up. Fear and uncertainty can lead to selling, driving prices down. So where are stocks bought and sold? On stock exchanges. These are marketplaces where buyers and sellers come together to trade stocks. Think of it like a giant farmer's market, but instead of vegetables, they're trading pieces of companies. Stock exchanges provide a platform for transparent and orderly trading. They set rules and regulations to ensure fair pricing and reduce risks for investors. It's like having referees at the market to make sure everyone is playing by the rules. Without stock exchanges, buying and selling stocks would be chaotic. It would be like trying to buy a slice of pizza in a crowded room with no order or system. Stock exchanges bring order to the chaos. Section 5. Where stocks trade: NYSE, NASDAQ and more. There are many stock exchanges around the world. The New York Stock Exchange, or NYSE, is the largest in the world by market capitalization. It's where many of the biggest and oldest companies list their stocks. Think of it like the main stage at a concert. The NASDAQ is another major exchange. It's known for listing technology companies, especially those in Silicon Valley. It's like the trendy club where the hottest new bands play. Each exchange has its own listing requirements and trading rules. Companies choose where to list their stock based on various factors like their size, industry, and investor base. It's like choosing the best venue for their performance. Section 6. Measuring the market, understanding stock indices. How do we track the overall performance of the stock market? We use stock indices. An index is like a basket of stocks representing a particular market or sector. Think of it like a sampler platter at the pizza place, giving you a taste of different options. The value of an index is calculated based on the combined prices of the stocks it includes. Changes in the index value reflect the overall movement of the market or sector it represents. It's like seeing if the whole platter is getting more or less expensive. Indices help investors understand market trends, compare their portfolio performance to the broader market, and make informed investment decisions. They provide a snapshot of the market's health. Section 7. The Dow Jones and S&P 500 famous indices. Some stock indices are household names. The Dow Jones Industrial Average, often called the Dow, is one of the oldest and most widely followed indices in the world. It tracks 30 large publicly owned companies based in the United States. Think of it like the classic pizza everyone knows and loves. The S&P 500 is another major index. It tracks 500 large companies listed on stock exchanges in the United States. It's broader than the Dow and considered a better representation of the overall US stock market. It's like a more diverse pizza with different toppings for different tastes. These indices are closely watched by investors and the media. Their movements can influence market sentiment and investor behavior. Section 8. Indices in action tracking market performance. When you hear on the news that the market is up today, they're usually referring to a major stock index like the Dow or S&P 500. If the index value has increased, it means the overall value of the stocks in that index has gone up. It's like the price of the sampler platter increasing because the individual slices are now worth more. Investors use indices to track their own portfolio performance. If their portfolio is outperforming a benchmark index, it means their investments are doing better than the average for that market or sector. It's like having a winning strategy at the pizza place, getting more value for your money. Indices also help investors identify market trends and make investment decisions. For example, if a particular sector index is consistently outperforming the broader market, it might signal an investment opportunity in that sector. It's like noticing that a certain type of pizza is always selling out, suggesting it's a popular choice. Section 9. Stocks, your gateway to company growth. Stocks are more than just pieces of paper or numbers on a screen. They represent ownership in real companies that are creating products, providing services, and driving innovation. When you invest in stocks, you're participating in the growth and success of these companies. Understanding the basics of the stock market is essential for anyone looking to build long-term wealth. While investing always carries risks, it also offers the potential for significant rewards. It's like taking a chance on a new pizza place. It might become your new favorite, or it might not live up to the hype. By learning about stocks, stock exchanges, and stock indices, you empower yourself to make informed investment decisions and potentially grow your wealth over time. Keep learning, stay curious.